Today, we're jumping into the world of financial trading. But forget everything you've seen in the movies with traders shouting in crowded pits. We're talking about a full-on revolution, one that's driven by artificial intelligence, where machines make split-second decisions that humans literally can't even process. So let's pull back the curtain and see how this new world actually works. To really wrap your head around the scale of this, just look at this number, 92%. A study back in 2019 found that 92% of all trading in the massive Forex market was already being done by algorithms, not people. Think about that. For every 10 trades made, more than 9 were executed by a machine. This isn't some futuristic trend, it's the reality of how our markets work right now. And this image just says it all, doesn't it? That iconic scene of a chaotic trading floor, people screaming, paper flying everywhere. Well, that's basically a museum piece now. The new reality? It's the quiet, cold hum of server racks, churning through millions of data points and firing off trades in milliseconds. The heart of the market isn't on a floor anymore. It's in a data center. All right, so let's dig into what this new trading floor really looks like, because its growth is just absolutely explosive. And if you want to understand modern finance, you've got to understand this. You know what they say? Follow the money. The AI trading market is already worth over $11 billion today. But get this, it's projected to nearly triple by 2030. This isn't some niche experiment. It's a massive, accelerating wave of investment into automating financial decisions. So what are we really talking about when we say algorithmic trading? Well, at its core, it's pretty simple. It just means using a computer program to make trades based on a bunch of predefined rules. Now, those rules could be super basic, like buy this stock if it crosses a certain price. Or they can be insanely complex, using machine learning to adapt on the fly. But the key ingredients are always the same. It's automated, it's precise, and it is unbelievably fast. Which brings us to the million-dollar question. How do you actually build one of these things? It might sound like something straight out of a Wall Street sci-fi movie, but the process can actually be broken down into some pretty logical steps. And they're becoming more accessible than you might think. First things first, before you write a single line of code, you need a strategy. The best way to think about it is like a recipe for a chef, or maybe the rules of engagement for a soldier. It has to be crystal clear. What are the exact market conditions, the ingredients that tell the AI to buy? When does it sell and take profit? And maybe most importantly, what's the emergency exit for cutting losses? Without those strict rules, an AI is just flying blind. So here's how that build process usually goes, in 4 key stages. First, you define that recipe we just talked about, your rules. Second, you pick your tools, maybe a programming language like Python. Third, and this is absolutely crucial, you backtest. You unleash your strategy on years of historical market data to see how it would have done. It's like a flight simulator for your money. And only after that, once you've analyzed the results and tweaked things, do you even think about deploying it with real cash on the line. Okay, so now that we get the process, let's look inside the toolbox. What are the actual platforms and cool techniques that traders are using to bring these strategies to life? What's really interesting here is that the tools are available for pretty much every skill level. This isn't just a game for giant hedge funds anymore. If you're a beginner, a tool like TradingView lets you test ideas visually, no code needed. For intermediate traders, something like FX Replay gives you a super realistic simulation. And then for the pros who want to go all in on automation, platforms like MT4 and MT5 let you build and deploy incredibly complex, custom-coded algorithms. So, after you've run your strategy through hundreds, maybe even thousands of simulated trades in a backtest, you're left with this mountain of data. And this is where AI really starts to shine. You can actually feed all that performance data into another AI model just to analyze the results and spot hidden patterns that a human analyst might completely miss. And this is the kind of gold you can find. The AI might comb through your trades and come back with a game-changing insight. For example, it might show that your strategy is a rock star during the New York and London market hours, but it consistently loses money during the Asian session. Wow, that is a powerful, data-driven insight that tells you exactly when your algorithm should be active and when it should be sitting on the sidelines. So yeah, AI offers this incredible power and precision. But, and this is a big but, this technology is a classic double-edged sword. It has huge potential upsides, but also some very, very serious risks that we've got to talk about. Let's break it down. On one hand, the promise is obvious. You get lightning-fast execution, trading that's totally free from human emotions like fear and greed, and this uncanny ability to spot patterns no human could ever see.
But the other side of the coin is just as stark. One single bug in the code can trigger catastrophic losses in seconds. A lot of these AI models are black boxes, which means their logic is so complex, even their creators can't fully explain why they make certain decisions. And if too many AIs start using similar strategies, you get market herding, which can turn a small dip into a full-blown crash.
And trust me, these risks are not just theoretical. We've seen it happen. These unexpected black swan events have shown us time and again how these automated systems can go horribly wrong. The flash crash of 2010, where the market nosedived and then recovered in minutes, algorithmic trading was a huge factor. And the Knight Capital collapse, that showed how a single bad algorithm could literally bankrupt a company in less than an hour. The destructive power is immense when things go wrong. Which really brings us to the most important point. As market analyst Jasper Osita puts it, no strategy is perfect. Only well-tested ones stand the test of time. AI is not a magic wand. At the end of the day, success still boils down to rigorous, relentless testing and having the discipline to constantly adapt based on what the cold, hard data is telling. All of this power and all of this risk inevitably brings us to some deep, profound questions about fairness, about transparency, and, about who's actually in charge of our financial markets anymore. I mean, really think about this for a second. When a self-driving algorithm causes a market crash, who's to blame? Is it the programmer who wrote the code, the investment firm that switched it on, or the government regulator who is supposed to be watching? The lines of responsibility get so blurry in this automated world, and honestly, these are questions we are all still struggling to answer. And the challenges go even deeper. You have models trained on old market data that accidentally learn and repeat old biases. You have this massive tech gap where big institutions with the fastest connections have a huge advantage over regular investors. And that black box problem makes it almost impossible to build trust. How can you explain to a client why they lost money when you don't fully understand the AI's decision yourself? It creates a system that's both incredibly powerful and dangerously opaque. And that leaves us with the core dilemma, the big question at the heart of it all. AI promises this dream of a perfectly efficient, totally logical financial market. But as we race towards that future, we have to stop and ask, at what cost? Are we sacrificing stability and fairness for the sake of speed? And can we really, truly stay in control of the very machines we've built to trade for us? These are the critical questions we'll all need to answer as this new world continues to unfold.